Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today is Thursday, July 13th. This is host Richard Bernoulli. Today we have Daniel Lacalle and Ira Harris. Daniel holds a PhD in economics and is chief economist at Tressis SV and has been ranked in the top 20 most influential economists in the world. He is author of several books, including Escape from the Central Bank Trap and Freedom or Equality. Ira is an independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003 and a stint most recently. Welcome, gentlemen.
Thank you.
Thank you so much.
Great. I thought we'd begin with the macro view, Daniel, on what you see in the economy, global economy, and the financial markets.
I think that the disparity between the financial markets and the global economy persists. No? On the one hand, we have a slowdown of the global economy that is pretty evident. The IEA just downgraded its estimates of global oil demand because of the weakness of the industrial sector. The manufacturing PMIs show that the global economy is quite weak in general. However, the service sector continues to perform pretty well, mostly from consumers basically using their savings. But the savings ratio that was accumulated throughout the pandemic is all gone. No? So I think that the tailwinds that have supported developed economies, the United States, the European Union in particular, in the last 12 months, are starting to fade. The first one being commodity prices. Commodities have declined very, very significantly, even to levels lower than previous to the Ukraine war. And that has certainly been a massive boost to GDP for most developed economies. The other one, obviously, is what I mentioned before. The services sector is starting to feel the pinch of elevated inflation and loss of those savings. And the impact of the stimulus plans that were implemented, that is already fading out. So I think that the global economy is in a slowdown environment. Mm-hmm. But global markets are booming. And the reason why global markets are booming is because everybody expects big monetary injection at some point and a big reverse in rate hikes. And to be fair, earnings have not been as bad as one would have feared. But the reality is that the entirety of the performance of equity markets, particularly in the United States and Europe, has been multiple expansion.
Mm-hmm. Very interesting. And your thoughts, Ira? Do you see similar aspects?
Well, there are so many, as you know, I like to say in paraphrasing Mao Zedong, there's a lot of dry tinder out there and is a single spark to ignite this tinder can come from so many places, and I think it keeps the market very fragile. Financial conditions, I think, are far more fragile than what the central banks are willing to admit, because if you're only looking at equity markets, and they're starting to wake up to it, it's just that as your dominant theme of financial conditions is just, I think, majorly flawed. I think financial conditions, if you look at equity markets, a lot of that comes from that the Japanese are still pushing money around the globe. So even as we raise rates, yes, the United States is involved in quantitative tightening, the Canadians are. Europe is, of course, minimus and I think we'll get into that discussion, at 15 billion a month. Yes, they're letting some stuff roll off, but the actual tightening still provides a lot of liquidity into the system. So this is good for equity markets, but I think there's underlying, as interest rates go higher, and of course, all this, as Peter Bookfire and others have certainly raised the issue, when it comes to refinancing the massive amount of debt, government as well as private, at higher levels, we're going to see some of these cracks in the underlying edifice start to, I think, those fissures will become much deeper. What will be the response, of course, from a financial perspective, the response from the central banks will be critical. But especially when we look at the Europeans, as Danielle and I talked for briefly before we started, there was that paper, May 31st, from the ECB. And the paper warns that if Japan interest rate policy normalizes, whatever normal means, well, they're negative 10 basis points. So what does normal mean? Zero? I mean,
Exactly.
it's so far from normal. I don't even know. I can't recognize it. But the paper warns what it would mean for the Europeans, and what the question that the ECB raises is because Japan investors have owned so many different sovereign bonds in Europe that if they were to pull back due to normalization, that it would create large problems for the European debt market, and that would lead to fragmenting of the interest of the bond market in Europe, because interest rates would widen, as we saw. How far, we don't know, but the ECB is evidently worried enough to put out this paper, and the paper got very little discussion. But to me, the ECB will continue to raise rates because they're not going to do quantitative tightening because of fear of fragmentation, and that comes from none other than Christine Lagarde. I mean, her main concern is the fragmentation of the bond markets.
You're based in Europe, Daniel. What are your thoughts on Europe and the ECB monetary policy?
I completely agree. And the problem of the ECB monetary policy is that it cannot expect to work if their objective is to run and stand still at the same time. It's impossible, no? So ultimately, the problem of the ECB is the following. It's worried about fragmentation, but the reason why there's fragmentation is because of fiscal policy. It has nothing to do with the ECB. So if the ECB, in order to avoid fragmentation in the bond market, decides to do what it is doing, which is penalizing the countries that are having a prudent fiscal policy and subsidizing via monetary policy the countries that are implementing a bad fiscal policy, guess what? I'm joining the party. There are countries that are running a 5% of GDP deficit this year that will be the ones benefited from the different programs that the ECB has, while the ones that are cutting the deficit will have to pay for it in higher inflation. So everything is, they basically, they have this view that they're going to control everything. And they love the example of Japan, but Japan is a very small island. It's a very large country, but it's a very, very small island with very specific demographic and economic conditions you cannot replicate in the European Union, no? So the problem of the ECB is the following. The entirety of the monetary policy normalization is falling on the shoulders of the private sector, on families, much larger mortgage rates, much more expensive credit card bills, etc., and businesses, which are seeing suddenly that the very cheap loans received to undertake the pandemic effects are being refinanced at 6, 7, even 9%, which is destruction for many of the small and medium enterprises. So on the one hand, the ECB is hiking rates, and on the other hand, it continues to disguise the fiscal imbalances of some of the European countries with this bond purchases. So how will that play out? Probably more elevated inflation for a more prolonged period of time. And I'm not sure if the Germans are going to be happy about this, because the Germans have just announced, and it hasn't reached many headlines, a 45 billion spending cut in the budget. This is a socialist party, by the way, a 45 billion spending cut, while in the south of Europe, the Italian with a right-wing government and the Spanish with a left-wing government have announced that they're not going to cut any spending whatsoever. They're going to continue to have whatever deficit there is. So that is going to generate problems in the midterm, 100% sure.
You mentioned also fiscal policy. There was initially a lot of talk on the Green New Deal. Is that still happening? And are there sufficient funds for that? There was some discussion, not enough funds.
Do they have enough funds? Well, no, but obviously you print them. No. It's the fiscal constraint is a monetary constraint. And the monetary constraint is whether the ECB, which has been quite successful at maintaining the euro above parity after a very, very risky process that could have led to a significant devaluation of the euro. But I don't think that there's any other. I mean, ultimately, the problem of the European Union is very, very simple, is that there is a mainstream narrative that says that the problems of the European Union of 2011 to 2014 were monetary problems, not fiscal problems. That therefore, and any budget cut, even if it's from stuff that was supposed to be extraordinary and that was supposed to be one-off, any budget cut is seen as the evil austerity is coming back. And it's going to be a problem. It's going to generate problems because, I just read that in the Southern European economies, most political parties in different areas are all agreeing on increasing pensions with CPI, increasing salaries of the public sector with CPI, increasing entitlements with CPI. Guess what? That means more monetary units being issued, and that at the same time, it will clash with those that suffer the inflation but don't have the budgetary expansion that some others continue to have.
Exactly. Any additional thoughts, Ira, on?
Yeah, and so, I mean, and it gets right to the point, because it is not a bond. It's a bond problem, but the issue isn't the bonds. There's no fiscal harmonization. So, and remember, when we got into COVID, there were those who were celebrating because they did that huge PEP offering, which they deemed the Hamiltonian moment, right? Where we were finally going to get, because that was a Euro bond per se, with the PEP bonds. And those are the ones that, of course, are rolling down, and they're trying to figure out what to do with them, and that they would get some sense of fiscal harmonization. But they're still locked into this problem, as Daniel talks about. And that's where we have to watch this, because now we saw the AfD in Germany just win a local election. First time. Yeah. Their numbers, and we know what's going on with the Dutch. So in the so-called Hanseatic Fives, we're definitely getting movements to the right, which will be opposed to the fiscal stimulus that the Southern European countries are desiring, and maybe some Eastern European countries, especially with what's going on with the terrible situation in Ukraine. So these are really on the plate. And interestingly enough, I think it was 2017 or 2018, maybe a little later, when Wolfgang Schäuble, of all people, made that oh, no, it was later than that because it was into COVID. When Wolfgang Schäuble made that comment, he said, well, we ought to give them not loans, but subsidies. Because if you gave them loans, and this was his words, which shocked me, we need to give them bread and not to put more stones in their pockets, which coming from Schäuble was quite a statement. But no, nothing's been done with that. And we know, as Daniel points out, and it's going to happen as the Germans get a little bit more leery about where this is with all the Target 2 stuff that's on the book. It's going back to Karlsruhe. And what will be the decision from the German High Court yet again? You know, they've softened, but as the German populace grows a little antagonistic, and it's coming. So, I mean, we're talking about this, but it's just one of those piles of tinder that we have to be careful about.
Mm-hmm. Daniel, what about shifting over to the U.S. and any thoughts on U.S. Federal Reserve monetary policy in terms of interest rates rising to any further extent?
Well, the United States is a completely different situation than the European Union. The European Union is in the middle of stagnation and recession with the aid of a massive next generation fund, while the United States is growing, not very much, but it has a fiscal problem. The deficit is way too high. But it's a fiscal problem that is by design. That is not, nothing would happen to the US economy if the budget would be revised down a little bit to reduce that deficit. So what I think is interesting about the United States is that you have a very hot labor market with negative real wage growth. And that is obviously a big problem, because when you have almost full employment, but negative real wage growth for 23 consecutive months, ultimately, there's a problem of productivity. There's a problem of productivity that is significantly evident in the U.S. economy. So the labor market is okay. The consumer is not okay. Obviously, the consumer real retail sales are also in negative territory, and we also have very low consumer confidence, which is logical with the inflation rate. So with a hot labor market, but real negative wage growth, with an economic growth that doesn't deliver significant productivity growth, and at the same time, all those elements of rising credit card debt, etc., I think that the Fed is likely to hike rates one more time, maybe two, the most, and then wait and see. I don't think that the Fed needs to do anything. In fact, I think that the Fed, from the monetary aspect, they might be concerned about the fiscal aspect, but it's not their job. But from the monetary aspect, they see that demand for US Treasuries is very robust. There is no problem there. They see that the labor market is strong, looking at the elements that they focus on. And they see that inflation is coming down, but it's not coming down as much as they expected. So that means one, maybe two rate hikes, and then waiting and seeing, unless something truly breaks. No?
Interesting. And your thoughts, Ira?
As I listen to Daniel, one thing came to mind. It's the printing press was invented in Europe, but it's Washington that has the authority to use it, unlike Brussels. So we've got to turn the world on its head. So I think the U.S. feels very comfortable with that, by the way, because as Daniel's opening point, the financing of this deficit is growing to difficult proportions, and it's going to become a political issue in this country. It's a political issue in Europe, and it'll become a very hot button issue in the U.S. Along with other issues, but I think that that's right. Now, interesting, there was a piece out this morning from, of all places, the Cato Institute, saying, let me see, that the Fed should continue to hold rates steady.
Hmm.
And I mean, I had to read it because it's Cato saying this, and I believe I probably align more with Cato as a sound money person. And I believe, reading as much as I've read of Daniel over the years, he's a very sound money person too. So it caught my eye, but their analysis is based on using the Taylor rule. And that based on the Taylor rule, for those who want a hard, fast rule, rates are high enough at this juncture until we see more things. But it did catch my eye. Now,
Yeah.
Right? You can't, you have to pay attention when somebody of that stature says, no, enough is enough. And if I'm a dove on the Fed, I'd say, where are we going? Even the Cato Institute says using the Taylor rule. And I'm, they may raise rates, but to me, of more interest, Daniel, will be what the vote will be. Powell has bent over to get unanimity in the vote. The hawkish pause was to buy off the 4 hawk voters wanting a quarter more. Does he, because I think that at this coming meeting, there's 4 doves. How do you buy them off? And the doves, I would say, and now we have a new, they approved out of the committee yesterday. So we'll get Kugler to be the new, we'll get seated. But we have Philip Jefferson. I make him a dove. Bostic seems to be dovish now. Goolsbee, based on the data, because he's a data, and I think that he's leaning that way anyway, I see 4 no votes if they raise rates, which as a market analyst and trader, I would love, because that would tell me more than anything else. I would like to see them finally, because we get the same nonsense out of Europe, right? As soon as we have the press conference after the ECB meets, and then as sure as the sun rises in the morning, Nagel, not others, will be out Friday and Saturday talking about the need for hire. As soon as Lacalle's press conference is over, where she talks about, oh yeah, we were all in agreement. Well, maybe not all in agreement, because they always come out after. I would like to see some open dissension at the Fed, because it would tell us, hawkish or dovish, dissent, stand up and you can't all agree. It's not possible. And I listen and read their speeches as everybody else does. And you can't all be in agreement. You come from different places. And I would say that there's 4 labor economists on that Fed board right now who are getting a little nervous that if the battle is to stem the rise of wages at the lower end, because again, we're back in this period where the lower end is actually doing better and you're getting a little compression from the high to the low, why would you forestall that? Why they've been so badly put upon by globalization. So I would like to see that dissension take place. I think it would be very healthy for the markets.
And how does all this play out, Daniel, in terms of the factors from the economy and monetary policies, fiscal policies in inflation, consumer price inflation, and just commodities, commodity prices as well?
Mm-hmm. Well, commodity prices have proven that inflation is a monetary phenomenon. Because think about this, in the middle of a massive war, with China recovering, with supply cuts, commodity prices have done nothing but fall from the moment that the Federal Reserve started hiking rates. Why? Because that means more expensive margin calls, more expensive transport, more expensive storage, more expensive refinancing of long positions. So that has been a positive element for inflation, but that has basically run its course. Commodities bottomed down basically in May, and they have been rising from there. And So the entire effect is gone from that, or not gone, but the commodity effect and the base effect are likely to stop playing in favor of lower inflation rates to work against commodities up, the base effect gone as from July. So in terms of the Fed, that's why it's more likely that we will see them take a neutral to hiking position than a neutral to lowering rates. Additionally, because like the ECB, they are not reducing their balance sheet at the pace that they expected to reduce it, and they obviously increased it once the banking crisis started to happen. So it's very unlikely that the Fed is going to undertake a much more hawkish position than simply moderate rate hikes and small reduction of the balance sheet. In terms of inflation, what that means, we're already seeing it. The narrative all over the place is for people to think that 4% is already an accomplishment. No? And 4% inflation rate every year is a lot of inflation for an economy that cannot deliver real wage growth and cannot deliver at the same time the financing of deposits at high rates. No, so we will likely see a further environment of improvement in core inflation. Now it's the opposite. No? We've had headline inflation coming down, core inflation going up. No, the likely scenario now is that core inflation starts to come down, but headline inflation may creep up because the loss of the tailwind of the base effect and the loss of the tailwind of energy. Look at the latest CPI print in the United States, no? 0.2% increase in inflation in June, out of which the energy component was 0.6%, an 0.6% increase. So the energy component is no longer the driving force of inflation reduction. If you look at the CPI print item by item, there were only 4 items in the US CPI print in negative territory in June. All of the others were rising.
Interesting. And your thoughts, Ira, on inflation and commodity prices? Yeah.
No, commodity prices, although they've started to stabilize, and they've given, especially I think the ECB, which probably gives more weight to them in their decision making because they import so much more of their energy, especially since we've had the fracking revolution. So they've got some relief there, which has helped. But we're starting to move up a little bit here, and I'm looking at the especially the Bloomberg Commodity Index, which I watch. It is stabilized. Some people are looking at it and going, "Oh, it's on the verge of breaking out." I don't know, to the upside, meaning that prices, food prices, are going to remain elevated. But those food prices, as I've learned years and years ago, for them to feed through the system is tougher than a lot of people think, because when you take the price of a bushel of wheat, it gets disseminated into so many different things. Yes, you'll see some, but it's not, its direct impact, unless there's a severe drought, is minimus compared to energy. When energy really flies, everything gets, it's so easy to see. You go to a gas pump, boom, we fill the car up and you see it. It's immediate. The food prices will take a while, but I would warn that food prices are actually holding here far better. And that's with record harvests, by the way. Food prices, and now we know that the wheat is coming out of the Black Sea, and I'd be very careful here with food prices. I don't know what's going on in Europe. Well, I do know a little bit. Last year they had drought. This year I think they've had better growing season. Mm-hmm. But the U.S., we're at historic low levels on storage. So if the summer heats up and we get drought in the US, look for food prices to go higher. And not because they've had a very good retracement off of what Daniel talks about off the Ukrainian situation. When we saw wheat get up to, I think, $13 a bushel, speaking in US terms, I think that was a high we saw. Let's see, I just want to be accurate. I'm pretty sure that's the number. Yes, following that, yeah, we got up to $13 a bushel wheat. So now we're down to 6.5, and it's been pretty well behaved there, even though the crop was damaged over the winter wheat crop was not as great. But I caution, I don't warn, I caution, the carryovers are very low. And this is not Joseph's Egypt. So we don't have the ability to build great storage because there's nothing to store. In fact, the Brazilians, who are really the biggest soybean producers in the world now, had a record crop, and yet prices remain elevated. It's been we have not seen that in my knowledge, because when you get that kind of huge record crops, and you had record crops in the US, you usually have big carryovers, and soybean prices would be down to $6, $7, $8 a bushel, but they're not. We got down to $12, $12.25, and don't hold me to those exact number. And now we're pushing on the August beans. We're at $14.60. So there are things here that you have to be worried about, but that's not what the Fed should, or any central bank should be. They've got the other issues, because to me, this is a situation they created. They went to negative interest rates. They went to zero interest rates. And even when the fiscal stimulus started to be filtered out from the legislative and executive, from the legislative bodies, they stayed firm and said, well, whatever happens, there will be transitory. That's when they should have been reacting to the fiscal. Now this is of their making, because they overstayed for a long time, and they have to work their way through this. But it's a matter, listen, we saw 4 major banks go down in a month. Now, yes, we've totally recovered from that. And nothing says that more than the movement we've had in the yield curves, the 2-10s. But again, as I'll say, there's only 2 yield curves, I think, in Europe that are positive.
Yeah.
Right? So, well, Spain is at 10 basis points. Greece, as well as Greece is doing, Greece and Italy are still positive. Greece is out to 88 basis points, but Italy's at 37. So all the curves are inverted. So there's a lot to pay attention to, because what is that market telling us? I don't know, because since we embarked upon QE and negative nominal rates, I don't know what any of this means anymore until we really get to a sense of normalization, and we're so far from it. And that's for everybody.
In Europe, Daniel, do you see any effects of the sort of insane World Economic Forum policies, like the anti-fertilizer, anti-fossil fuels, what we see in Netherlands and France? Any effects of that on agricultural commodity prices?
Not in agricultural commodity prices, but for example, in the southern countries, olive oil prices have gone through the roof. And the narrative is that it's because of the drought, but the reality is because of many of these misguided so-called environmental policies that have made it virtually impossible to improve the crops and to improve the production. No? So food inflation, due to the double impact of very large taxation and the so-called environmental policies, I would like to stress the concept of so-called, because they're not environmental policies.
Right.
They're basically they're not in my backyard policies, which is a completely different thing. Is you can pollute anything you want as long as I don't see it, and I will purchase it at a much higher price, maybe even subsidize the other countries to produce it. So that is a big problem in Europe, because although the FAO food price index has come down quite significantly, with rate hikes like other commodities. One of the things that has been phenomenal in European Union countries is to see how food prices continue to rise. And there is a double impact because I mentioned those misguided so-called environmental policies, but the biggest challenge in Europe is the following. The agricultural sector is extremely, how would you call fragmented? It's hugely fragmented. And what governments have taken the opportunity is to introduce taxes throughout the entire chain so that food prices go up exponentially when inflation is up. So for example, a kilogram of tomatoes is 47 cents and reaches 2 euros per kilogram in the shop because there's increasing taxes. And taxes are a percentage of the previous price. So imagine, the agricultural price, and then the storage, and then the transport, and then the freezing, and then the packaging, and then the distribution, and then the minority distribution, and final shop. All of those have their own 21% VAT tax, or 16 or 13, I don't care. So it's a big problem. And it's a big problem politically. Ira mentioned the most important thing that is happening in the European Union right now and the least talked about, which is the very aggressive rise of right-wing populist parties and this is the interesting thing, are gathering most of their votes from radical left-wing populist parties. And the reason why these right-wing parties are gathering momentum is precisely because they have identified that the European Union is destroying the primary sector. And the primary sector is certainly suffering, and they see that there is significant voting potential there. You mentioned the Netherlands. The Netherlands is a huge example of that, of how one piece of stupid policy that means nothing in the global, means literally nothing in the global context and in the European Union context, creates a backlash to an allegedly classic liberal party that generates a lot of support for a radical right-wing party. It happened in Italy. It's happening in Spain. In Spain, the next elections are very likely to see a radical right-wing party taking hold, that because they identify those things. They identify that hunters are angry, that farmers are angry, that the entire primary sector is angry, and obviously that creates significant discontent. So that I don't see any way in which that is at least stopped anytime soon.
Mm-hmm. And in terms of where you see the investment opportunities, given all of this in the environment, what's happening economically and financially, what are your thoughts like on the global South, emerging markets, Brazil, Argentina, Colombia, Indonesia, and even in China for investments? Yep.
From an investment perspective, everything that is happening on the monetary side doesn't help the re-rating of emerging markets. And as you've seen, they're not performing, they're not seeing the level of multiple expansion that we would assume would happen in an environment like the one that we've talked about. But it's creating very large opportunities, in my opinion, precisely because the relative valuations start to be hugely attractive. China has enormous problems, and I'm not going to recommend anyone to purchase massive amounts of their portfolio in China, but there are good companies out there trading at multiples that you simply cannot even fathom in any of the developed economies. and companies that are actually exporting and selling in dollars, so that are benefited if the concern about the Chinese market is a big yuan devaluation. We are seeing a stealth devaluation, but people are worried about a huge devaluation that will cripple the market. That is fine. But that creates an opportunity in those companies that export and that have their costs in yuan. The same happens with emerging economies now. Latin America is suffering because of a monetary concern. Latin America has been taken over by people in the political world that believe that doing the same thing that Argentina did is going to work this time if they do it themselves, and that doesn't happen. So that is affecting valuations. But again, in infrastructure, in exporting sectors, I think that there are good opportunities out there. However, on an overall portfolio, I would not recommend anyone to be any less than 80% US exposed, and use the other 20% to play around with gold and emerging economies. But valuations can be attractive now, no? With those caveats.
Oh, interesting. And your thoughts, Sarah, on that?
Well, the world is certainly, as we've talked about now with Daniel recently, but of course, we did Peter Bookvar yesterday, and we've had some interesting, actually last week, I don't know whether you're familiar with their work or not, Goering and Rosenzweig, so Adam Rosenzweig was on, so that was really good because we covered the energy markets, and with Dr. Anas Ahalaji. So I don't know what I was doing there, but I was in the middle of some very, very good energy.
Great discussion altogether.
Yeah, it was. So, I mean, we've covered these, and it is, it's perplexing to people how well the emerging markets have really done. And as Peter Bookvar points out, the emerging market bond markets have really outperformed by a great deal. But I think we saw in the COVID years, and even before that, that the emerging markets kind of shifted because the currencies are not fixed like they were. I can remember back to the tequila crisis of 1994, 95, and I was sitting on a regulatory committee in Washington, chaired by Sheila Bair, and all the regulators were going, Mexico. I said, there's no crisis because the Mexicans have finally learned to let the currency float. So the currency provided a shock absorber for what was going on. Let it go. And they're so aware of it that in this time, when they saw inflation starting to rise, that for them it wasn't transitory, they got out ahead of it. I mean, the Brazilians became very aggressive in raising rates. The Central Bank of Mexico got aggressive because the dollar, as Daniel talks about, I mean, there's benefits because the dollar, they couldn't afford, there's so much borrowing in dollars globally. Yeah. And we saw that. We were talking about this yesterday, that if you look at the low in the S&P in October of 2022, the most recent low, it absolutely is in synergy with the dollar up at 114 on the dollar index. Now we're down at 100, 100, exactly 100 on the dollar index. And we've had a sizable rally because global finance is not being as constricted by a strong dollar. I mean, listen, I always take umbrage that the Fed has a dual mandate. When you're the world's reserve currency, you have more than a dual mandate. So whether you just get right, and it showed that because the world was really, because what were the central banks doing? And even, and I think Augustin Carsten, who heads the BIS, talked about it, that the central banks of the emerging markets were getting out in front of the developed central banks because they had to protect against a severe drop in their currencies because it would have been disastrous. You want to see a deflationary spiral, that would have created somewhat of a deflationary spiral. So we are there, and we're seeing things. And with the weakening dollar, I think there are positives, as Daniel, especially for those who have dollar debts, which are enormous. And then, of course, there's China. Now, what is China doing? And we come back to that. And Daniel, I'm going to, for people who listen to this, they're going to go, he's talking about it again. But I look at the UN, at the yen yuan, because I think the Chinese pay attention to what's going on in Japan.
Yeah.
It's a big issue in Asia, especially. And a weak yen begets a weak yuan. And why do I say that? Because if we go back to December 1993, the yen yuan was at 19.22 yen to a yuan. It's exactly, as we talk, where it is right now. Exactly. But it was on January 1st of 1994 that the Chinese devalued the yuan by 50%, which drove the yuan down to 12 yen to a yuan. But it also happened to be the first day of NAFTA taking place. So the Chinese, so we have to be very aware as to what the Chinese are doing. I know people are looking for a devaluation, maybe, but I'm in the kind of Michael Pettis camp. If they do that, then China is going to move away from a domestic consumer-led economy and go back to that model of pure mercantilism and driving exports, which will be deflationary for the world again. So I think your point is well taken, but it's something that we have to watch. I know because the Chinese are watching it. And what, you know, and here we are at that level again, and it boggles my mind. 30 years on with everything that's taken place, and here's the yen yuan at the exact same level of December 1993. So yes, one more thing to watch, but the emerging markets, the United States, I'm not as bullish, but I'm older. So I'm now able to get 5.5% on 1 year money. You know, 19 months ago, 20 months ago, I was getting maybe 25 basis points. So for me, that's significant. So do I want to be as loaded up? No, but as my friend Angelo Gallo talks about, if you look what's going on in the United States, the industrial stocks are doing really well. Everybody's talking about the AI, but if you look at, and what is it? Angelo has he watches this RSPN, I think it's an ETF of major industrials. And that's because we do know also something that is bothering Europe is that there's a lot of factory construction taking place in the United States because what we call the New Powell doctrine, or when Jake Sullivan gave that speech at Brookings talking about a policy with the Inflation Reduction Act, which is driving the Europeans crazy, right? Because the United States is basically violating every rule of the WTO with these subsidies, which are trying to reshore industry here. So those are things that I'm looking at, to me, as very investable areas. I'm very aware of what this is taking place. But there are European stocks that I like. I really like ABB because I think they have that massive green footprint. They're great engineers, and they will also partake in the rebuilding of Ukraine. So there are stocks like that. I'm also like some of the European banks, which for me, that's total heresy. But I think that there are, I've been very bullish on Commerce. I think we've talked about that I thought Commerce was an interesting play because they were, I mean, you look at those valuations, it's insane. And now they've gone back to paying a dividend, which I was looking for them to do. So we'll see where they go from there, but they have such a big footprint in Germany that it's always worth paying attention to.
Mm-hmm.
Any thoughts on that, Daniel, on the reshoring? Is it coming back to Mexico or to US also to some extent?
The movement of industry is very evident in because as well of those bureaucratic, administrative, and energy climate policies that have been implemented in the European Union. So, interestingly enough, I actually mentioned this on an interview, that the concerns of the European Union about the Anti-Inflation Act are quite interesting, because the European Union is, I don't know, is a giant pool of subsidies all over the place, and at the same time, protectionist measures against others using the environmental concerns. So the movement of industry from the European Union elsewhere is unstoppable. The movement of industry is going to two areas: to India, going from China to other Asian countries as well, because of the challenges with China, etc., and moving to the United States because of the combination of legal security, investor security, and much more, I would say, not benign, but much more logical environmental and administrative burdens. No? In the case of Latin America, I think it depends a lot on the countries. Many industries are moving to Mexico because they have dollarized earnings, which is fine, but others simply can't because they cannot afford, in their cost of capital, the currency risk. No? And Colombia's currency is doing pretty well, but you never know when they're going to change the mandate of the central bank and start printing like there's no tomorrow. We don't know. So I think that we're going to see a lot more concentration of industry driven by legal and investor security more than anything else. And I think that trend is unstoppable, because I don't think that anybody would say now, okay, let's build a large factory in France, in Italy, or in Spain that is not in heavily subsidized or protected sectors. No? So very complicated.
And just any final thoughts, and maybe your thoughts on like gold, silver, Bitcoin, any final thoughts? And also, how can our listeners learn more about your work, just coming to an end here?
Okay. From the perspective of gold and silver, I always think that you need to have some gold in your portfolio, because we never know when there's going to be a correction. But if you want to see opportunities to purchase other assets in a correction, having gold as a decorrelated asset works very, very well. And it worked in 2022, and it will work in the next correction if there is one, which is very likely. Bitcoin to me is very uncomfortable because it's 100% correlated to the NASDAQ top companies. Yeah. So what do I prefer to have? Do I want to have Bitcoin, or do I want to have some Meta, or some I don't know, some Amazon, or some Netflix? I don't know.
Right. Good point. Yeah.
But it's basically the same thing.
Yeah.
It is basically a large duration asset, entirely dependent on whether the Fed is going to cut rates or whether the Fed is going to hike rates. Silver, not very good trend right now. So I would be cautious short term, but ultimately I would look at precious metals probably more into the second half of the year, when the economic slowdown and the reality of whether we have persistent inflation or deflationary pressures are more evident.
Great. And how can our listeners, viewers, learn more about your work?
It's easier to find me than to avoid me. Huh? So,
yeah. Okay.
So You search Daniel Lacalle, and you have me on Twitter, 2 accounts, one in Spanish, one in English, 2 YouTube channels, one in Spanish, one in English, and 2 websites, one in Spanish, one in English. So D Lacalle, and not difficult to find.
Yeah, and we also post many of your videos also on our website, media website.
Thank you.
Great, and Ira, your thoughts on gold, silver, Bitcoin?
But with gold, especially, I'll speak to that. For me, it's never the inflation hedge; it's the hedge against central bank credibility in the world of fiat currency. To me, if you start buying gold when you fear inflation, it's probably already too late. But if you pay attention to what central banks are doing, and central banks, to me, have really played with their credibility, and they've felt comfortable with it because it's been a unified effort. When they read their statements, for the most part, they all look like they all came out of, what you call it, out of artificial intelligence. They go, well, how should I read this statement? It's all the same statement. They plagiarize from each other. And I think that they're trying, and the basis of what the Fed is doing is trying to recapture its credibility. There's no question about it, because they know that mistakes were made, that they stayed well, now we talk about higher for longer, but the mantra was for 24 months, 30 months, maybe longer, was lower for longer. That they were, Powell at that Jackson Hole speech talked about flexible, adjustable inflation targeting, where we could go over the 2% target, which I can't stand anyway, and hold it there because we've been under for so long, and that we would just smooth it out by some mathematical formula, and then everything would be okay. So now they're fighting because they lost that battle, and everybody else, they're all fighting for their credibility. And as I talked about yesterday, it is amazing that gold is held up in the face of these yield curve inversions. That typically does not happen. You want to, when Volcker went after gold, what did he do? He inverted that curve, and we know the enormity. This time it's not, and it's one of the things that I pay attention to, because why isn't it correcting? By my metrics and measurements, gold should be down to its huge support level of 1580 to 1630 in this type of interest rate environment, and yet here we sit. So that tells me that until that gives way, and central banks have really clawed back some of their credibility, and that may come down to the BOJ, by the way, because I think the BOJ is a bank that, by its policy, sends a lot of liquidity around the world, which keeps financial assets elevated. But there's a lot on the table here, and some of these things are going to give way, good or bad. We will find out. We will find out how much stomach the central banks have towards meeting their 2% target, which I even hate that they're married to that. And I'm not the only one. Paul Volcker himself disliked that 2% target immensely. Yeah. And he wrote about it. It's amazing. You can pick and choose from anybody you want. So they talk about being Volcker, but Volcker was opposed to so much of what they do on a daily basis anyway. And you can find me here. And I love Daniel's line about it's easier to find me than it is to avoid me.
Right.
Yeah. And I would say, before my wife and I got married, that would be our mantra too. It was easier to find me than now it's.
Okay.
So I love that line.
Great. Awesome. Awesome insights. Great discussion. Food for thought. Thank you so much, Daniel and Ira. Thank you.
Thank you, Richard. Thank you, Daniel. Be well. Thank you.
Have a good day. Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.